If you're a busy clean energy professional like me working in Sub-Saharan Africa, then you would know how difficult it is to get news about our industry. You're probably following all the blogs and LinkedIn pages just to get up-to-date news. Well, we have a solution for that now. We're launching a newsletter called Clean Energy Africa that will deliver news about the clean energy sector in Sub-Saharan Africa directly to your inbox 2 times a month. If you would like to subscribe to get up-to-date news and stay on top of everything happening in the industry, then check out the link on the top of our show notes to sign up to our newsletter. Now to the episode. Hello and welcome to the Energy Talk podcast. My name is Olubumi Olajide. On this podcast, we tell stories about Sub-Saharan Africa's energy transition, focusing first on the policymakers, financiers, and operators that are bringing us towards a sustainable energy future. On this episode, we're speaking with Gilles. Gilles served as the CEO of InfraCo Africa for nearly 5 years and recently started his new position at the Private Infrastructure Development Group as their Chief Investment and Project Development Officer for InfraCo. InfraCo is a part of the Private Infrastructure Development Group, and on this episode, we'll be focusing on the work that Gilles did while part of InfraCo Africa. InfraCo Africa provides funding and expertise to infrastructure projects, enabling them to grow from an initial concept to a bankable investment opportunity and further to a viable operating business. InfraCo Africa provides equity to projects in the early stages of their development, all the way through construction and operational stages. So far, InfraCo has invested over $300 million into projects in Sub-Saharan Africa, supporting 39 projects and businesses, and mobilizing over $1.5 billion. On this episode, Gilles will talk to us about their investment mandate, the theory behind the operating model, and the notable projects that InfraCo Africa has been involved in. First, I'll let Gilles come in and tell us how he first got into the clean energy sector.
I did not start my career immediately in the energy sector, even though I trained as a hydroelectric engineer. So it took me like a couple of years to get into the energy sector. And I first started in a business that was doing midstream and downstream natural gas. So really my first exposure was with basically bringing natural gas to residential and industrial clients.
How many years ago was that, and how did you transition into investments?
So that was quite a while ago. That was in the early 2000s, so 24 years ago. I started doing very, very much technical work. I was an engineering manager. I then became a project manager working on gas distribution, natural gas distribution. And I always back then the renewable energy industry was really starting to pick up. And I very much wanted to work in renewable energy. It just felt like something I wanted to be doing in my career. So after a couple of years working on pretty operational stuff, I took a break from working. I got an MBA, and that allowed me to transition to sort of more strategic and commercial work. And that's when I subsequently got involved in the renewable energy industry. I also changed locations. I went back to Europe for a couple of years because my work in natural gas had been in Latin America. So I went back to Europe and started working for a big power utility and started making my inroads, if you will, into business development. So transitioning from really technical work to more commercial work. And then that was the start of what's been now almost 20 years of working in infrastructure development and financing. I joined InfraCo Africa in late 2019, just before the start of the pandemic. And it was really an opportunity for me to pivot more to the development finance space. I'd been working for all of my career in, I would say, classic, purely commercial, purely for-profit corporations. And there was an opportunity to do work more in development finance with a more impactful mandate, focusing specifically on Africa, which was a region that I'd been working on already for several years, but with a mandate to take more risk for the sake of achieving more impact and working on stuff that was ultimately more sustainable. So that's how I got into InfraCo. So we're basically an investment and asset management organization. So our core business really is to invest. And so as one might expect, we've got a lot of legal and finance people, business developers. So our bread and butter, really, our core processes are about originating deals, doing due diligence, modeling financial returns, and basically negotiating and executing essentially equity documentation. And then once we've made those investments, we sort of hand them over to our asset management team, because it's just because you've made an investment doesn't mean it's all done and dusted. There's a lot of work to be done in nurturing the investments we make with our partners. Most of the time to develop a project, I would say all of the time, developing a project is an entrepreneurial process and requires risk capital. And so it's expensive to develop a project. Like if you're developing a renewable energy project, you're going to have to spend quite a lot of money up front on doing a lot of studies, maybe even putting up like some infrastructure to measure wind speeds or to assess like hydro potential. You're going to have to be doing some geological work, digging some holes in the ground, trying to understand if the soil is stable. So it's actually quite expensive to develop a project, and quite a lot of developers simply don't have that capital to pay for all that early stage work. And there are not a lot of development finance institutions who want to finance that risk, because you, just as that entrepreneur can lose the money, you can also lose your money. So you find that a lot of the development capital comes at a much later stage in the form of debt, which is a lot more secured and a lot safer. And that's a real problem. That's a real problem, and that's a problem we're trying to solve by bringing equity. So that's what makes us pretty unique. We're not the only ones, but I think we're one of the development finance organizations which provides the largest amounts of early stage risk capital.
So you said there's a very small pool of equity providers for infrastructure at this early of a stage. And I want you to speak more into what partners you work with to kind of support that, to support the structure that InfraCo Africa has. And then we can get into more of the specific projects that you've done and what the impact you're getting out of those early investments.
So our partners are private sector developers or entrepreneurs, typically people or groups of people or development companies who are like developing a greenfield infrastructure project. Also entrepreneurs who are developing maybe a startup, if it's not like a classical sort of infrastructure project, but more a startup. And we also, and I can come back to that later, just in terms of balancing our portfolio so that we're not just on a portfolio basis super exposed to early stage risk. We also make investments in companies that are more mature, but that are still sort of at a growth stage and whose activities are very aligned with our mandate. On the funding side, we're funded by governments. We're funded by the overseas development aid agencies of those governments, and who have that capacity to take more risk. It's not like all of their development budget is going into this kind of risk profile, but they do have a mandate to support this kind of funding. The scaling up, I think, is really challenging. One way of scaling up is just to increase the size of your teams and the amount of deals that you're processing. Another way to scale up is to start looking at platforms or developers, or to fund development organizations that themselves are working on several projects. So you have sort of a multiplier effect. I think those are the two main vectors of scaling up.
That's very interesting. Earlier, you mentioned something I want to get a bit deeper into. You mentioned that it's a people's business at the end. And it's interesting because for outsiders from the DRE space, especially looking from the outside in, it might look like the work you're doing is very high risk. There's the perceived risk of the work you're doing. But internally at InfraCo, what methodology do you use to kind of like communicate that to outsiders, to your funders, and also to the companies that you work with? Do you see it the same way, as this is a very high risk, high reward kind of category, or do you have a different opinion around that?
Okay, I mean, we high risk, high reward, not necessarily what's at the front of our minds. I mean, the conventional way to look at investments, of course, is that if you take a lot of risk, well, then you should have a high reward to compensate that risk, especially on a portfolio level, right? Because you're going to have some investments that fail. And that means that in those that don't fail, you need to be making extraordinary returns to offset that risk you took. That's sort of the classic financial way of looking at it. If you look at it from a more developmental perspective, the bigger picture is pioneering or priming the pump for a particular kind of activity, a particular kind of infrastructure, a particular kind of business, which is super important for a particular country to engage on its energy transition or just to reduce poverty. Getting entrepreneurs to progress and develop their projects, show that there is a success, then sort of primes the pump and gets a process moving whereby success begets success. The business community or the government in that particular country sees there as a success, and also there is a learning effect. So for us, what's important is to get those projects, those early stage projects, moving and to show that it is possible to be successful and to generate a if you will, a virtuous circle. So we're not necessarily looking at taking risk in order to make a high reward. We're looking at taking risk so that we can get a process going where for the next projects, the private sector capital flows more freely, is more available. The governments are more supportive. The templates are better understood. The legislation is more developed, and basically we overcome those initial barriers to private sector investment, and at some point de-risk the sector sufficiently that private capital just continues on its own. If we can achieve that sort of catalyzing effect, then it's a success from the point of view of our investors and from the point of view of the theory that ultimately private sector has to be the answer to many of the problems, right? So that's really the success that we're looking for. We're looking to catalyze private sector involvement in infrastructure. And if the first projects in which we're involved in don't necessarily make high rewards, that's okay. That's okay. Of course, we're also looking to make money and to make a reward, but that's not the primary goal.
Okay. So what I'm hearing from you certainly is there is an ecosystem build aspect to the work that you're doing. And perhaps some more cynical listeners of the podcast would ask, okay, that's all well and good, but how do you exit these investments? And perhaps that's something you can dig into a little bit. So in terms of your exit strategy, what's the time frame you're looking to to hold these assets, whether it is the early stage startups or the more mature players that are actually deploying large scale infrastructure projects. What does that look like from you from a thesis standpoint? And in actuality, how has that developed over the years?
So the exits is really the toughest part, and recycling our capital, that's really tough because we've typically taken inordinately high risk compared to what the private sector is ready to do. The projects, those pioneering projects, have typically had to bear higher costs, and so the cake, as it were, that is still remaining to share with follow-on investors in an exit is typically not as rich. So we do make exits to funds, to infrastructure funds, for example. So some of our renewable energy projects we've exited them fully, and they've been purchased by, I would say, relatively well-known infrastructure funds who were actually happy to be able to buy into a de-risked project that had reached very advanced stages, either close to end of construction or even operation. We've also been able to exit to institutional investors in some cases. So I think it's a combination of strategic funds and other kind of operators. But it's not easy. It's not easy. It is one of the most challenging parts of my job, which is to show that at the end of the day, the investments we make can be divested successfully. But yeah, it is an integral part of our strategy. I would say from a timing perspective, I think even very commercial developers and investors acknowledge that in the African context, the cycle from making investments to exiting can be quite long. 5 years, 6 years, 7 years. That's the kind of time frames we're dealing with. I mean, the time frames for developing infrastructure, building them and exiting them in Sub-Saharan Africa are typically, I would say, 5 to 10 years.
This is Olu, host of the podcast, interrupting this episode to let you know that we're looking for sponsors to support our work covering the sustainable energy transition in Sub-Saharan Africa. In the 5 years since starting this project, we've grown the platform to a top 10% ranked podcast globally, and we're looking to go even further. If your organization or fund would like to learn more about reaching thousands of engaged listeners monthly, then reach out to us with the email in the show notes of this episode. And for our listeners, you can continue to support us for free by sharing this episode with the people in your network, leaving a review in your favorite listening platform, and signing up to the newsletter linked in the show notes of this episode. Now, back to the conversation. Well, pretty lengthy period, and let's start at the beginning of that pipeline. So let's just run through a quick scenario. So let's say I was the CEO of a DRA company in Nigeria. As there's a major debt subsidy program that just got approved. So let's say I have like 10 million worth of mini grid projects under a subsidy program. It's all been signed. And I come to InfraCo asking, okay, can you guys give me some equity to fund this portfolio? What are the criteria typically that you would look at to decide whether or not to make an investment decision? And you can also expand beyond just that scenario I gave you.
Okay, so we actually invest a lot in DRE projects because there's 500 or 600 million African citizens who don't have access to centralized electricity distribution. One of the key success factors is the track record of the developer. So we are not a provider of super early stage capital or like technical assistance, right? So if you're a DRE developer and you come to us and you say, hey, look, I've already developed and I've got in operation some infrastructure. I've got a couple of hundred clients on a pilot project, or maybe I've done a grid, or I've put in place some solar home systems, and I can prove to you that I actually know how to implement and operate. I've put capital at risk, which shows that there's skin in the game, and this is somebody who's going to work hard to protect and make that investment bloom. That for us is extremely important. I would say that the skin in the game and the background of that, of the track record of that developer, is probably the single most important thing that we look at. Then we're also going to see if there is at least some basic kind of sophistication, in the sense that you've got sort of the wherewithal to develop a business, understand how to run a business. So you've got some management capacities, you've got some management controls in place, and you can sort of prove to us that you're going to manage HR, manage money and treasury and operations. Just that what you're doing, that you're able to generate proper processes and documentation. Yeah, I think those are also super, super important. And then, and that I think a lot of thing which is something which people overlook is, do you have a business plan? Do you have like an Excel business plan, which is pretty detailed, which shows that you've thought about a multi-year model of your business? You can model your costs, you can model your revenues, and we can actually work with you to see what the profitability of your business is going to look like. So if all those things are there, that's already a very strong indicator for us that this business is going to be successful. Obviously, there's your more sort of classical due diligence. We're going to do a market study just to understand what the market is like. If there's a market to expand, if the regulation is going to be supportive. So kind of the market study is pretty important. I mean, it's very standard, it's very plain vanilla, but at least you're trying to understand the environment in which you're going to be operating. So I think a market study is also something we also do. I think that those are the main things that we'd be looking at, when we make an investment.
Okay, so let's set another scene. So let's say you are having dinner with a few friends, colleagues in the industries, other industries, and you're all talking about work. Is there any one project in the 5-6 years at InfraCo Africa that you like to go back to and kind of a bit like humble brag about? And can you tell us that story and what impact that project is having since deployed?
I think that one of the projects that we're particularly proud of is a transport business on Lake Victoria. I think if you look at Lake Victoria on the East African map, it's really it's at a crossroads, first of all, and it opens up trade to a number of landlocked countries, like, for example, Uganda. And I think at some point in time, let's say in the 40s and 50s, you had quite a lot of trade that was happening around and on Lake Victoria, where you had basically railroads interconnecting with scheduled freight service across the lake, and that way Uganda could export goods to Kenya and Tanzania, and vice versa. Stuff could come into Uganda from Kenya and Tanzania, and then I think there was a period of time where that infrastructure sort of deteriorated, and traders and logistics were reverting to basically road traffic. And so we invested in a project which is just about to go commercial, which is to reinstate the first scheduled roll-on, roll-off ferry service, international roll-on, roll-off ferry service across Lake Victoria, reducing journey time by 3 days. Because right now, the route from Uganda to Tanzania is basically a grueling 3-day long drive around the lake, around the western shores of the lake. And there's a lot of risk around that. There's traffic accidents. There's also a lot of time wasted. And from an environmental perspective, there's a lot of CO2 emissions, whereas marine transport is just a lot more efficient from an emissions point of view. So we've been developing this with a regional logistics company out of South Africa called Grindrod Logistics. So it's a joint venture between InfraCo Africa and Grindrod Logistics. And it's a pretty sizable investment. It's very pioneering because very few private businesses want to take the risk of restarting what has essentially been an infrastructure that has stopped existing, which is proper, scheduled, state-of-the-art roll-on, roll-off ferries. So we're particularly proud of that project. We think it's going to do extremely well, and it's just been a great partnership with our partners.
That is an excellent example, and also good to hear about the impact on ground. So I want to talk about the CLARE Fund, the Climate Energy Resilience Fund. So this is the $200 million African climate focused fund that was closed by Helios, and InfraCo was a very instrumental part to establishing that around the first close. So could you walk us through that and what the involvement is, what InfraCo's involvement is on the CLARE Fund, and then use the opportunity as well to talk more broadly about how you see the role of partnerships in the ecosystem?
Just so that you're aware, so we're part of a group called the Private Infrastructure Development Group, which actually works a lot on capital markets development as well. And the reason for that is very simple. Infrastructure is very capital intensive, and the capital markets, which typically provide capital for infrastructure development, are not mature enough or not competitive enough in the Sub-Saharan African context. And so a lot of innovation needs to take place in capital markets to basically improve the capital market offerings to infrastructure projects. So Page does a lot of work in capital markets, and private equity is certainly one of a very big participant of, or a very big player in the capital market ecosystem. So where there are opportunities for Pidge to get involved in capital market development, we seize those opportunities. So we're not just an infrastructure developer. We do a lot of very varied kind of work. We had the opportunity at InfraCo Africa to basically get involved in designing a private equity fund that would invest specifically in climate, but also beyond climate, because the economic transition of Sub-Saharan Africa is not just about climate, although it all sort of, ultimately it all comes together because it's all about sustainability, whether it's transport or energy or agriculture or telecoms. It's ultimately about financing businesses that bring about a more sustainable and a more just economy, right? So we had the opportunity to design a fund and to anchor it with a pretty large amount of capital, because I think that one of the key success factors to getting a fund launched and financed is the initial anchor investment. If somebody is putting in, as we did, almost $50 million, it's a much more realistic process and pitch to start collecting more money and reaching a scale that becomes interesting. So we had the opportunity to design a fund. We had the anchor capital for the fund, and we had a pretty clear idea of what we wanted this fund to invest in. And so we then basically ran a process where we identified one of the most successful fund managers on the African continent, who is Helios Investment Partners, who have a very strong record of raising capital and deploying capital and making good returns to their investors. And I think for them, there was an opportunity to also go into climate. I think this historically, they'd been a pretty generalist fund manager and a successful one at that. Like climate is becoming super important. And so I think when it all came together, our DNA around infrastructure and sustainable businesses, our anchor investment and their track record as a fund manager, it all sort of came together. And it took a long time because right now the environment for fundraising is not that easy. But a couple of weeks ago, we announced, or we all announced, that the fund had raised $200 million. And is, by the way, the objective is to raise 400 million. So it is only halfway there. But I think that there is that the train is out of the station, as it were, and the fundraise has been a success. It will start to deploy its capital and it will continue raising more. And we see this as being the largest pure African fund, private equity fund, dedicated to climate and sustainability.
Yeah, thank you very much for that walkthrough. And you said something that climate is becoming a lot more important. I think it might be, to some sense, that climate is becoming a lot more commercially viable, especially for the investment group. But this has been a very good conversation. And the way we like to end interviews on the podcast is to ask, with all the amazing work you're doing with InfraCo and with your partners, how would you define failure in the work that you're doing?
Well, I think that as for any investment organization, ultimately failure for us means the failure of one of our investments, in the sense that it's unable to deliver on its objectives. We are a patient investor. That means we are ready to wait longer and to support longer a business than maybe more pure commercial investors, because patience is sometimes fundamental. I mean, so we are very privileged to have pretty sizable capital that we can deploy, but we've got to make sure that we've got good processes in place so that we're efficient. We're not burning too much overhead by just keeping our teams and our operations going, but not deploying capital. So failure for me is also not having a high enough pace of investments. And that's also something that we can mitigate by having strong management, good processes, and just having a sort of urgency to continue doing good work. So I think those would be the two.
Thank you for joining this episode of the podcast. I hope you enjoyed the conversation. And since you made it this far, please make sure you're following the podcast wherever you listen, and also share with a friend or colleague who might also find this conversation insightful. This episode was produced by Chigozie Uba and edited by Africa Business Radio. I hope you have a great rest of your week and see you again on the next episode. Bye for now.